Let me take it across to Nilesh. First up, Nilesh, your first thoughts on the policy. In fact, important announcements being made by the RBI governor, and he also said that there is a need for policy support from all sides. Do you believe that's perhaps a cue for North Block that we have done enough on the monetary policy side? It's now on to the fiscal side as we're, coming out of the second wave of COVID-19.
The RBI has continued its policy of maintaining adequate liquidity, keeping interest rates under check, managing inflation, supporting growth, and providing credit facility for needy sector of economy. But many of these sectors like healthcare, tourism, travel will also require equity rather than just debt. And that is where fiscal has to step in. RBI, like Bank of Japan, cannot provide equity capital to Indian companies. We are far, far away from that. So in our context, fiscal step will be necessary to support needy sector of economies in tourism, travel, or small and medium enterprises. At the same time, RBI has also maintained, development of financial markets. So my feeling is that this policy is in continuation of the excellent work which RBI has been doing.
Right, Kaushik, if I can come to you, how do you look at the announcement for GSAP 2.0 and how, at a time when there is already enough liquidity into the system, how do you, see that announcement coming in? And especially also on the on-tap liquidity that has been opened up for contact-intensive sectors, for example, hospitality, for example, all the tourism-based industries as well, MSMEs. How is this really going to aid a lot of industries as we're coming out of the second wave?
Ruchi, first let me take the GSAP question. As I mentioned in your pre-policy expectations show that we are expecting GSAP announcement of 40,000 crore for April-June. And I had said that GSAP 2 would be announced about 1 trillion. Now RBI has decided to increase it a bit more to 1,20,000 crore. Normally, for QE kind of programs to kind of work and kind of make markets more positive in their sentiment, the numbers need to be increased. So if they had announced 1 trillion INR worth of GSAP, it would have been more or less, expected. Everybody had expected RBI to announce GSAP 2.0 of 1 trillion. So to some extent, whether 20,000 crore would be enough for the markets to be happy or not is a separate question. But RBI has tried to, increase the number, and that doesn't mean that they'll keep on increasing every quarter. Probably RBI wants to support the economy in a front-loaded manner when the growth is on the weaker side. If you see RBI's growth forecast, they have actually reduced the forecast for the whole year. But the second half of the financial year, they have increased the growth forecast quite significantly. And therefore, once we go to the October-December quarter, it could be possible that GSAP could be scaled down a bit when the support may not be required that much. So we have to see in that context. The second point is that the on-tap liquidity facility that they have announced for contact-intensive sectors. This should be seen together with the announcement that were done on 5th May. You should not see this particular policy on a standalone basis because RBI already announced a number of measures on 5th May. So it should be seen a continuation based on feedback that different sectors have given RBI based on what announcement was done on 5th May, where improvement could have taken place, where the coverage could have been extended. And I think RBI has, for the time being, taken those decisions and increased the coverage a bit. This is not the end of the story. If there is more support required, we have the August policy. I'm sure in between now and August policy, the government will come out and announce a number of fiscal measures. They are already probably preparing a lot of things at this point of time. But as Nilesh mentioned, that there's no point of announcing a big kind of stimulus when the economy is already kind of in a lockdown. So once the lockdowns are lifted slowly from June and probably in July, probably second half of June is a good time when you can expect the government to come and announce more fiscal measures. And RBI already indicated that there should be more support from different sectors apart from the monetary levers.
And one of the most respected macroeconomists in the country. Pranab, Nilesh and Kaushik certainly have given a thumbs up to the RBI's policy today. Do you share their optimism or do you have any reservations, given that what we've seen on the inflation front and the fact that growth doesn't seem to have responded to RBI signals? Pranab?
Is that for me?
Yes, Pranab, that is for you.
Oh, it is for me. Okay. Well, the thing is that as far as RBI is concerned, I completely agree with what Nilesh had said. RBI has done a stellar job and it continues to do so. I have a somewhat different opinion on the GSAP, because what the GSAP is really nothing more than a pre-announced open market operation. That's what it is in effect. Now, the point is that at the moment, announcing a larger GSAP, I think pretty much amounts to saying that we are really worried, number one. Number two is we are going to look through the inflationary pressures. And inflationary pressures are certainly there, and the likelihood is that it's going to get a lot worse. If the information that we're getting from rural areas is any indication, we may start seeing consumer price inflation starting to inch northwards. Not inch, maybe even speed northwards. So I'm not sure whether the message that the RBI is going to look past the inflation numbers is something that you want to convey at this particular stage. I think a better approach would have been a clearer statement of intent, saying that the RBI shall stand and support the fiscal measures that the government may wish to take, along with whatever kind of sort of fundraising that the government will need in terms of the GSECs being put out onto the market, rather than, give a very clear indication that we are now going to ignore inflation.
Minority here in thinking that the RBI's monetary policy statement should have sounded a slightly more cautious note on the liquidity front and also on the rising inflationary pressures. But now we're also joined by Ashwini Kumar from State Bank of India. So let me ask him a question related to banking. Ashwini, the governor said that they're going to now think in terms of not just adding to the structural liquidity, but also in terms of the equitable distribution of liquidity. But what we saw last time around, when the RBI did announce a special window for small finance banks, this was not really taken up. So is the question really one of liquidity, or is it a question of a combination of corporates not being wanting to borrow, and banks not being able to lend simply because there are no creditworthy proposals, not because you don't want NPAs to come back on your books? So if you do your due diligence in today's environment, there really isn't much of a case for lending, even under the ECLGS scheme, because as one has seen, guarantee schemes very often in the past, the guarantor has very often not, honored its commitment on one pretext to the other. So is the fact of, directed credit, directed liquidity, is that something that is not really going to reap any benefits, Ashwini?
Yeah, so good morning and thank you for that question. I agree with you that this is the liquidity window which has been made available earlier and which is being made available now may not be fully utilized. Now you have to look at the parallels from what the Fed did last year when they made available so much of liquidity across markets, but the actual take-up was not so much. So therefore, in our case also, it is the sentiment which counts because of the large liquidity available, that people know, the banks and the participants know there is a backstop available were things to get difficult. So that sentiment actually leads to the expectations of interest rates being under control and funds being available should they be required. And that plays a real role. I think the central banks have learned their lesson from 2008 when the liquidity crisis to begin with then spilled over into the credit cycle. So I think that is the sentiment behind all this liquidity being made available. I agree with you, it may not be needed fully. On the side of whether the banks will be lending more and more, banks are looking for opportunities. We have a lot of liquidity. But as pointed out earlier by a lot of participants, this entire lending piece today has to be seen alongside the other modes of borrowing, which is the corporates are raising the CPs, and banks are also participating in debentures. So all of that, if you take together, the rate of growth of corporate credit is slightly more. Having said that, yes, the corporate investment is still not to the levels which are probably required or which we would want. But on the MSME side and all, the current imperative is more than anything else, it is to keep these units sustained. I mean, otherwise, a lot of these smaller units will go under. So what no one wants is that these units will go under. And the banks, therefore, last year also, whatever growth we saw was through the emergency line of credit. And I think such measures, which are by the name also emergency, are really, really useful. So these kind of special measures announced today, like for the contact intensive centers, I think will go a long way. We were already supporting them through various measures, but this is a dedicated measure, and hopefully it will put a lot more focus on these kind of sectors, and banks will lend more. We are really looking to do that so that these units sustain. MSME, I mean, has to survive this phase where the demand is low, where the impact of things on individuals and is high. Once you get past this, I hope the investment cycle will also kick in.
On the fact that you need to support MSMEs because they are the ones who really provide the jobs, not the large corporates. But on the question of the ECLGS scheme, the government had announced a 3 lakh crore limit, and you already use almost more than 2.5 lakh crore. So is there a very strong case for extending this guarantee? Because this is only a guarantee. There is no outright, expenditure by the government. So why is the government fighting shy of increasing the guarantee limit? Any guesses?
Is not the government is not feeling shy or falling short. In fact, in conversations with us, the government has very clearly indicated that this would be enhanced to the extent and for the time it is necessary. And so we are quite sure that this would come into being. And that you've also already seen the ECLGS 3.0, 4.0, those different versions are already on. So therefore, the total amount, because it was not used, so there was no need to enhance it and announce it ahead of time. But as soon as it gets closer to the time, and in our feedback, we have been conveying to the government that there is a need to continue for some more time, because this wave 2 came in as a little bit of a surprise to all of us, and especially the intensity of it. So therefore, the need for continuing this for some more time is probably there, and they are very sympathetic to the idea. I'm sure as soon as it reaches that figure of 3 lakh crores or thereabouts, there will be an extension. So we are quite hopeful of that.
Pranav, before the monetary policy statement and right now at the moment, Ashwini also drew a reference to what the Fed did, what the ECB did, etc. But do you think we're comparing apples and oranges? Because they are not poor democracies. They are democracies, the US as well as ECB, I mean the area, the European Union. But they are not poor democracies, and inflation over there is very low. Yes, in the US there are signs that it is picking up. In the European Union also there are signs that it is picking up. But we are talking about a country which has shown an average inflation of 6.2% last year, which is showing signs of a K-shaped recovery. So are the comparisons with the Fed and the ECB not quite relevant for us, Pranav?
Relevant at all, actually. I mean, you have to remember one thing, that ultimately what the Fed or the RBI or any monetary authority does is and should be contingent upon what's happening on the fiscal side. Now, all the countries that you have talked about have actually announced large fiscal measures very early in the day. And in fact, rolling out of those fiscal measures are already very much on track. And the net result, of course, is that their monetary authorities have to then be in sync with what is going on and make sure that the markets are under control. In our case, the roles seem to be reversed. It is that the RBI is actually taking the lead in a lot of matters, and the government seems to be trailing in this, which means that the RBI's behavior has to be different. And RBI has actually been, every policy since last year, RBI has been stressing on the need for fiscal support in very polite words. But they've been doing it. But the net result of all of that is RBI's behavior of necessity has to be different from that of the Fed or the Bank of England.
Right. Nilesh, if I can come to you, this is Ruchi here once again. The RBI has projected FY22 real GDP growth at 9.5% as against 10.5%. That was their projection earlier. And this is, of course, coming in after a slew of downgrades for the Indian economy have come in from, Moody's to ICRA to SBI as well. Going forward, given the fact that, there is, of course, a big risk of a third wave as well, what kind of downside risks do you see for this growth target that has been set out by the RBI?
A lot will depend upon how we come out of second wave, what kind of stimulus package we provide, and how do we contain third wave. Today, from the street point of view, there is belief that vaccination will help us contain third wave. Vaccination will help us normalize economic activities by third quarter of current year. Now, if the actual events are in line with expectations of the street, then this 9.5% GDP growth number can be achieved. If we remember last year, in June 20, a lot of people had downgraded GDP, including RBI. And fortunately, we saw a sharp recovery towards September, December, and March quarter. Now, that was all possible because economic activities could normalize as post-September active cases came down rapidly. Let's hope and pray that with vaccination, we are able to normalize economic activities just like last year. And third wave is smaller than second wave.
Before I take it across to our other guests, I just have a follow-up question on that. Nilesh, given the fact that now a lot of people are, in fact, SBI itself in their report have spoken about that that we will no longer see a V-shaped recovery. The shape of the recovery is perhaps going to be a W-shaped recovery that we are likely to see from these levels. And there is, of course, a fear psychosis that is going to play on the minds of a lot of people as well. Concerns emanating that there will be demand-side pressures that we will see. So even as the RBI governor today has said that we need policy support from all sides, what kind of measures would you really expect the government of India to take as as the risks of a third wave and of course that big challenge that lies ahead of us of vaccinating the entire country also is there?
Health crisis, and we have to first tackle the health issue. Now, answer to that is vaccination as shown in Israel, as shown in UK, as shown in US. So you ramp up vaccination, you ramp up healthcare infrastructure, that hopefully will take care of third wave. The second one is the economic issue. There are long shadows on economy from the second wave. Your consumer sentiment will be subdued compared to pent-up demand in first wave because of death and destruction witnessed by people. Your small and medium enterprises, as Mr. Bhatia mentioned, have been hit hard from the second wave compared to even first wave. They will require support. There is widespread disease in rural India. Now, rural India has some things going for them in terms of higher agriculture commodity prices. But what will be the impact of this disease, we have to observe. So we need to provide stimulus to ensure that consumer sentiment improves. Now, this could be done by way of variety of measures, a GST rate cut on certain items, cash transfer like Pradhan Mantri Kisan Samman Yojana, or some other measures like stamp duty cuts on real estate, which pushes people to prepone their purchases. The small and medium enterprises, as Mr. Bhatia suggested, there is emergency credit guarantee scheme available that can be enhanced, that can be extended, that can be increased. The third thing will be your, rural India. And here probably you have support from good monsoon and higher agriculture commodity prices, but we still need to observe the impact of widespread of disease this time. So there is a need for fiscal stimulus to take care of consumer sentiment, to take care of MSME enterprises, and to observe rural India and take care if needed.
Right. Let me also take it across to Ashwini. Ashwini, just want to understand from you, given the fact that we are seeing the RBI has given a go-ahead for banks as well to restructure loans. The earlier limit was 25 crores. The current limit that the RBI has now set is 50 crores. What kind of a support do you expect that the MSMEs are likely to get with this decision, given the fact that we're seeing MSME space pretty crunched as a result of the second wave of COVID-19?
Yeah, so the MSME space is under pressure. That is something all of us realize and see. However, if you look at the last year's example, we shouldn't really be comparing these two waves, but the last year's example showed us that the ECGLS really helped. I mean, as the number was given out by Maithili also, 250,000 more than that has already been used up. But the restructuring scheme, even for MSMEs last year, we didn't have so many people who came in to ask for it as we had expected. So therefore, I think what is more important is that those who really have the need and who can just survive through this, that comfort should be there. People, if they need money, they will surely come in, and we have put in place all the policies and procedures for the 25 crore window. And now, of course, the limit has gone up, so we will scale it up. It is important for not only people to know that this help is available, but it is for us to also reach out. So we are also launching awareness campaigns among the MSME sectors, because many of their offices or many of their workplaces could be closed. So we are reaching out proactively to them and say that this is available. If you need the money, please come in. And I think a mix of the facilities availability and the awareness and the other things which are happening in the economy, all of that should help this period to go under. As some of the other participants have already said, this wave 2 is already on its way down. On the rural India, the anecdotal evidence, while the spread is known and is being talked about, but the real impact is actually not quantified yet. And to my assessment, the economic side of that would not be as bad as some of the people are saying. To me, it seems like today, I mean, the sowing season really starts off in July. So therefore, by this time, hopefully the wave would be on its way out and significantly reduced. And since the procurement has really seen records being set over so many years, monsoon is expected to be normal. So the rural demand, though it looks like today that it might be crimped, that may not really be the case. It might surprise us on the upside. So I think there are positive factors, even despite all this gloom around us.
Rise about the fact that RBI has been going on to GSEPs, not just once, but twice and quite aggressively. But at the same time, at the regular auctions, the RBI keep refusing bids. So is there some contradiction that the RBI is still trying to influence the yields and not accepting the market signals? Kaushik?
Yeah, so I think by cancelling some auctions, RBI has been giving signal to the market that they want markets to clear at a particular rate. Now, you can say that probably 6% is the kind of mark at which RBI wants 10-year bond yields to clear. Now, the question is, you should also see that along with that, there has been a lot of green shoe that has happened. So on a net basis, we have to see how much more RBI will probably need to borrow going forward, whatever they have cancelled. So this can be a problem in case it gets bunched up too much at a later point of time. Also, there is an issue that the GST compensation cess, which has not been finalized yet, the center might have to borrow again and give it to the states. So there could be further borrowing requirement from the market compared to whatever has been announced so far. Now, whether the government comes up with that announcement in the first half of this financial year, or the borrowing program is enhanced in the second half of the financial year because of giving more compensation cess to the states, that also needs to be seen. So more or less, we have factored in that yields are supposed to inch up through this FY22, but RBI is trying to ensure as much as they can keep the 10-year bond yields towards 6%, at least in the initial first half of the year. And then second half, if the growth improves, along with that, then they'll let the yields move up in the normal course of direction. And given what is happening globally as well, where US yields are, whether the Fed is getting ready to talk about tapering, that also is a concern. US inflation is a concern. Global oil prices have gone above $70 per barrel. So that will also be taken into consideration. But that is more a story of, I think, starting from October, that RBI will want markets to kind of, operate on its own and, will step aside a bit. On the growth, I just wanted to mention, if you remember, and as Nilesh mentioned a few minutes back, that last year when we had a minus 24% growth, contraction in April, June, when RBI gave the forecast in October for FY21 GDP data, they gave minus 9.5%. And that time the consensus was also, even more than minus 9.5%. And the actual number came at minus 7.3%. And actually the GDP growth would have been better if not for the subsidy related issue. It would have been close to minus 7% if not for the subsidy related complication. So my point is RBI has come down to minus 9.5, which is what the consensus is at this point of time. But if you look at the COVID trajectory, we are at 135,000 cases per day. If you see the IIT scientists model, Sutra model, they're saying that by June end, daily new cases could fall to as low as less than 30,000 cases. And, if that happens, then, the mood can change very swiftly. And along with that, government has already indicated that from July, the vaccination drive will be boosted significantly. They're already making plans for it. So suddenly, July, September, October, December may not look as bad compared to whatever the predictions are at this stage. Now, 9.5%, 10.5% growth in FY22 is not a good number, even if you achieve that, simply because it is coming on the back of minus 7.3%. The output gap will remain negative, so RBI will need to be supportive. So all that is given. But just on a mechanical basis, given that the base is so low of last year, I think you could still achieve 10.5% if the COVID cases come down to 30,000, daily cases 30,000 by the end of June.
I know you have to go, so I'll let you go, but I just cannot help remark that it's good to know that there are people who still have faith in these mathematical models, at least as far as the virus is concerned, number one. Also, number two, since you're an economist, I think I can ask you this statement. Remember what Adam Smith said, it's not from the benevolence of the butcher, the baker, etc., that he argued for market clearing rates of interest. So why is it in the case of bonds alone, the RBI does not believe in the benevolence of the butcher, the baker? So maybe something for you to think about. But I'm afraid on that note, it's time for us to slip into a very short break. We'll be back very soon. Please do stay with us.